Hi there, investors. It's Nick and
Hi, it's Martin.
We're just having a conversation about capital growth. Yesterday, I spent a lot of time going through the numbers. I even did a video looking at the data and so on. And now I've had a chance to sleep in it. And I haven't had the opportunity to actually have a conversation with you, Martin, about this. And we got talking just before I pressed the record button. And I realized that actually this is probably worth recording and sharing. So I'll just give some framework on this and then we go from there. So the short of it is that yesterday I spent a lot of time, well, over the last number of days, I spent a lot of time just looking at the data, trying to work out some sort of set of relationships which can help predict which areas are going to do well, which aren't, and so on. And overall, I would say that obviously we're in a property cycle and cycles happen and all that stuff. So we know that. The question is, where are we in the cycle? Well, we're at the end of the cycle based on a whole load of kind of correlatory information. And then the question is, well, how do you know which areas are overbought, which ones are going to crash heavily and so on? And when I went through the historic data from 2008, which is really good data because it's recorded in the same way as it is now. So it really is like for like. And broadly, there's no real correlation between the areas that crashed heavily in the past and areas that are like aggressively growing in the past and areas that are aggressively growing in the present. There is a relationship between how much an area will crash and the socioeconomic profile of the area. So broadly speaking, the better off the area, the less likely it is to crash. That's the correlation. But beyond that, then the next question is, well, okay, if we've got a couple of years left in this property cycle, how do I maximize my gain and minimize my risk? And the answer is that firstly, you can't really look at areas that did well and then crashed because there's no correlation with what happened then to what happens now. So therefore, one has to abstract this a little bit and just look at the characteristics of those areas that survived and did okay in the crash. And broadly, as I said, they're the ones where people who have the means to buy want to buy. And the thing to remember with all of this is you only need if you look at the overall market and you look at the number of sales per 1,000 people and so on, it's typically like 10 sales per 1,000 people. So therefore, if you assume three people in a household average, then that represents about 3% of the market making the market. So in other words, 3% of houses in an area, they get sold and they effectively set the levels for the market. And then people go, well, the prices are rising. Well, yeah, for 3% of properties in the whole area for that year. So it's quite an odd, sort of deceptive thing. Like, you don't need that many better off people competing for property to then set the market for the whole area. So this is an interesting thing. And broadly, what I've concluded is that to predict the future on a local property market, it's best just to look at what's been going on over the last 5 years and to look at general affordability. In other words, look at the socioeconomic makeup of the area, see if the area is going up. Now, one good indicator is new build, but if the area is kind of moving up and it's a fundamentally good area and there are fundamental reasons why people want to live there, you know, who've got more money, those 3%, remember, those 3% of buyers who make the whole market. And it'll be down to location, it'll be down to perceived value and all of this. And so it all goes back to the fundamentals, which are the demographics decent? Are there good local amenities? Are the transport links good? Is the housing stock good? And if you look at stuff objectively from that point of view, I think you'll be okay. When it goes wrong is when people go, well, it must be good because everyone else is buying in there, like city centre apartments in the last property cycle. And so many of those have just tanked and they're going nowhere still. And people go, well, they must be good because the price is going up, so therefore I'll buy too because it must be good. But that's kind of ignoring the fundamentals. Another good example of delusion is going, well, it must be a good investment, even though it backs onto a railway and there's a motorway 200 meters down the road, and well, there's a fish and chip shop just like 10 meters away. It's got to be good because the properties are going up in the area. But it doesn't take much of a pullback in the market for that property, that compromised property, just to tank when times are bad.
Yeah. Or just double yellow line on the street. Like,
yeah, that's another good one. So
yeah,
anyway, so that's my kind of general view based on the data that I'm seeing. That the secret is there isn't much of a secret. You just got to keep to the rules, the principles of what makes a good property. But Martin, you tell me what when you look at it, what's your overview of what's going on?
I will just we'll discuss about Stockport, for example. What I noticed, like properties 2019, the properties was 130, 2-bedrooms terrace house, now going up to 200. Depends of conditions. So basically it have like 40% growth without inflation, which is really a lot. So I think it's just overbought, and if it have a crash, it will crash. Maybe it's a risk. You never know because wealth people buying there, so it will not have a lot of crash, but it's possible to have. So like you cannot predict, but
so can I add to that actually? Because
yeah.
it's just a point that I wanted to make. It's a really thing. It's kind of a moment of enlightenment on my part when I realized, that's what's going on. What tends to happen in an area is that prices get inflated because of a small proportion of the population driving the prices up. And then what seems to happen is that the prices kind of hold at a certain level as long as the socioeconomic stuff holds as well. So in other words, people go, well, that's the price. It must be better, and therefore I'll pay the extra. And where prices decline is when you have a catastrophic issue. So we see this in Bradford, for example, or Blackpool. But we also see prices decline because the economy declines in a whole area. So it might be a town somewhere and the big factory closes and then everything just like melts, as it were. And when that happens, obviously you have price decline. So generally speaking, what I've noticed is that price increases happen on a kind of area by area basis, and then they go up and they kind of hold. And then what happens is that inflation does its thing and prices stay static for a long time. Inflation keeps rising and the relative value of the property decreases because inflation increases. So in other words, people's wages increase and so on. And so if you look at it in terms of like cost of property measured against average annual salary, basically property prices decline relative to salary over time if the market goes sideways. So what tends to happen is you have these spurts, which we're in now, and then it just kind of plateaus out. Anyway, go back to you, Martin, about Stockport.
Yeah.
That's why I think places like Stockport will hold. They'll go up and then they hold and they go sideways for years.
Yeah, but I just don't like the places where it's too overbought. But if you can find a good price, yes, it's good to buy. But some properties are like 2-bedroom terrace house, more than 100 here, and selling for 200K. I don't think it's the best place to invest. better buy, like it's a great area, but like depends of the price. So maybe I can share a screen and show how was the prices previously, how are they now, and how they're increasing like day by day.
Cool. Yeah.
Yeah. This is right move plus, so you can see that, yeah, this was the auction, so no, 130, 135, like in 2019. You can see like 150, 120, depends what, I'm just talking about 2-bedroom terrace house. You can see around 150 was, after in 2020, end of 2020, it rise up to 160, 165, 155, depends on the condition and how you're going. In 2020, become 150 to 170. This is like, and you can see like how the prices is going.
Well, I think one of the dangers
yeah.
of Stockport is a bit like the dangers that people encountered in the last cycle when they bought apartments in places like Liverpool L1 or whatever it was, that they think, right, it's always going to go up, it's a good investment, and they just forget the fundamentals. And so what's happening in Stockport is it's an investor-driven market. Oh, is that?
My internet connection was unstable. Yeah, so yeah, so in 2020 you can see around 180. In 21, 180, even 200 some properties, 210, 180. So basically it's and now it's around 200. So basically it's like not the best in my case, like when the areas are so overbought, I don't think it's a good time to buy right now.
Yeah. And you know, it's really odd and interesting as well. Whenever we put a property out in stock for Stockport, Swinton, and what's the other one beginning with S? Stockport, Salford. Whenever we put a property out there, just so many people grab and clamor for the property, but yet, you know, they're outbid because like people fall in love with the idea of the place, but the reality is not as good as the idea. There are different places that are fundamentally better. And this is what I'm seeing as well. I think if you just keep to the fundamentals, you'll be good. And it's just, this is when you know it becomes speculative and dangerous. And it's too late to buy in these places now, I think. Oh, connection's a bit shy. There you go, you're back. Hello.
Yeah.
Hello. It's a bit of a messy connection, but anyway, you're back.
Yeah.
So what's your opinion then with the market as a whole? Like, what's your advice?
My advice to not go in the hottest area, because first of all, when the asking price is 180, it will sell for 200. So, or 210. So why to overpay at the end? And after you will have more, if you're buying with mortgage, the validation will be 180. So basically the 220K, basically you need to pay it in cash more, because just to, so that's also an issue when you're buying a property where it's a really hot market. So because we have situation property asking price was 180 and it sell for 230. So
yeah,
it was
that was an exceptional
really
location.
Yeah, and the condition was bad, and we were surprised that a lot of people chased the deal.
Well, that's what I'm saying actually. That the properties that are in poor condition are being snapped up by investors now. So we always said, like, just find a property in fairly poor condition, renovate it, you get the owner occupiers out of the way. But what's happening is that the investors are getting so aggressive that they're just piling into these properties, and it's an issue. So yeah, it's the market's on the turn, and my advice is consider capital growth, but consider yield more, and look for those places where the yield is attractive, but the properties are decent, where people aren't fighting it out, and where you've got a decent chance of just getting your money invested and let it sit for a while. But I definitely think the game has shifted away from capital gain, which is kind of sad because we won't see this again for a long time. And the only time we're going to so what's going to happen now, I think, is for the next couple of years, it'll just be mayhem. It's a good idea to avoid these mad areas. Places like Doncaster are interesting, but what's happening is that, you know, people are displacing to those towns as well. So one of the big projects is to do the city assessments and just find these other gold mines, because they're out there, and we have the tech and the knowledge to find them. But you know, it's just property is still a great thing to do. It's just being sensible where you put your money. And
I'll try to avoid those hot area because first you need to overpay. Second, you have lower chance to take it. Maybe you will get distracted after that, and you will put on hold yourself from purchasing another property. So my advice, like, go for, like, let's say if you're going 30k Manchester, search in Middleton, maybe Moorstone, maybe Radcliffe, Little Hulton, I don't know, Denton, Royston, maybe. Depends. There is a lot of area where it's not that hot, like where you have more chances to purchase a property. But at the end of the day, depends what kind of people will go for this property, what kind of competition you will have, and we will never know until you view the property and see how many people are offering, viewing, and so on.
Yeah, it's always a numbers game, but because it's a numbers game, there's also probability. And the whole trick is to upweight the probability in your favor by being a strong buyer, by picking areas where, you know, we're seeing a growth trend, that it's not overbought, that it represents reasonable value, that yields are good. And yields are really a critical metric in all of this, obviously. And if the yields are good and the local rental market is strong, then really that's kind of everything in a sense. So, but the trick is to find those places where it's sustainable. And what often happens in really aggressive rental markets is that it's not sustainable and people just don't want to pay, or they can't pay, or whatever. There's a downturn. So overall, I think the whole trick is to find places which have strong yields. So what's a strong yield? Well, if you're a UK buyer at 5.4% probably. If you're foreign national, what do you reckon, Martin?
Depends on the price, but the most is 5. I will go 5.4, 5.5 at least.
For foreign national would be the least yield, and sensible maximum yield.
More than 7 is, if you buy it and the yield is more than 7, it's not HMO. It will be, I don't want to say, but donkey property. It will not be the best one. I mean, it will be really old, and it will have some issues in the future and so on. So basically, my advice, more than 6.6, it's something is more than 7 is something wrong with the property. But I'm talking about the asking price. So usually when the asking price and the yield is around 6.6, 6.5, at the end with the bidding finish, it will be 6.2 or 6. So usually, because of the bid, depends. Also, it's important how much is the asking price and how much is the accepted offer. Usually, it's around 5-10%, depends of the asking.
Yeah, I think if you can get gross rentable yield, i.e., you buy the property, excluding all the fees and stamp duty and all that stuff, plus the cost of renovation, if it's 6% or 6.2, something like that, you're in the right kind of place with it. But again, the whole thing is quality of stock and strength of local economy. So in other words, you find that the nice property in the nice location in an area that's got a nice solid local economy that's going in the right direction, then I think it's interesting. And for what it's worth, I've started looking at the Northeast, and there's some interesting stuff going on there. There's some clear correlations between gross domestic product and the local market. Sorry, the local market, and that's something I'll be exploring with you in the city assessments. Anyway, okay, any final comments from you, Martin, before we sign off?
Nothing for now. Know what you want, what kind of property you want, and stick on the areas what you think that it will work for you. And if you like the hot area, just prepare to bid high. So
yeah,
if you want to really to buy a property, you need to bid high right now in the market. So at least 5% in the asking price, but I will advise you 10. So you will have, if the asking price is 150, go for 165. You will have more chance to buy the property.
And my final comment is pay close attention to the fundamentals. Always ask yourself, if I was to live there, not you personally, but imagine, put yourself in the mind of the tenant. Is this a house that a nice person who always pays their bills and will keep their job in a downturn, is this the kind of house that they would want to live in? And if it is, then you're off to a good start, basically. So always remain objective and just take greed out of it. Just put yourself in the mind of the person that would want to live there and fall in love with your house and stay there for a long time and pay their bills and all of that. And if you do that, that's a good place to go. Anyway, all right. Thank you very much.
Thank you.